The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alasdair Macleod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alasdair Macleod on behalf of Gold Money, and with me on the line from Idaho is John Rubino, whose website is dollarcollapse.com. John co-authored a book with our very own James Turk in 2007 called The Dollar Collapse and How to Profit from It, and it was published by Doubleday. John worked on Wall Street from the 1980s as a bond trader, an equity analyst, and finally a junk bond analyst. During the 1990s, he turned columnist and author and currently writes for CFA magazine. Welcome to the podcast, John.
Thanks for having me on, Alasdair.
Idaho isn't all that far away from California. We hear very little about Idaho, but we hear that California is in an absolute financial mess. Is this true?
Yeah, the U.S. in general is a financial mess, and California in particular over near us. So it's interesting now that Europe is hogging all the headlines, but the U.S. has a lot of troubles of its own, which will become front page news in due course. It's just a matter of different trouble spots moving on and off the front burner as far as the media goes.
Yeah, that's very much the feeling I get. I should think that America is quite happy in that sense, that Europe is hogging the headlines. That really is deteriorating into something which is very difficult for to see how they're going to get out of. Is it something that you follow? Do you follow Europe? I just wondered what your perspective might be.
Oh, of course. Yeah, I think the whole world right now is following Europe. It's a fascinating story, and meaningful for everyone. You know, Europe is. I think the Eurozone is the biggest single economy in the world right now, and it's a huge export and import market for most of the other trading countries in the world. So yeah, what happens in Europe matters to everyone, and it doesn't look like there's an easy way out. And the reason for it, which you've heard plenty of times before, is that the euro common currency was set up with some very basic design flaws that are now coming to light, and it's left the peripheral countries with excessive debt and no real way of paying their debt because they can't devalue national currencies because they don't have them anymore, and it's left the core countries in Europe basically on the hook for the debt of the periphery countries, and the only two solutions left are kind of a big bang breakup where the Eurozone just fractures, which would cause probably a global depression, certainly a European depression. And the other alternative is a fiscal union along the lines of the United States, with basically Germany running the show, which for obvious reasons isn't the preferred choice of most of Europe. But that's it. Those are the only two choices. And so they're sorting it out now. And I suspect the process is going to go on for a long time and going to be very, very messy and possibly catastrophic. But we'll have to see because we've never been here before, so there's no way to predict the details and the specifics of the process as it unfolds.
Yes, I agree with that. It's always impossible to know in advance exactly what the future holds. But I think the solution that the creditor nations within the Eurozone take control of some sort, economic or political control of the other nations, to put together that solution takes quite a lot of time. I don't know about you, but I don't feel there is that much time. I think the time is probably measured in weeks rather than years. I might compromise and say a few months, but it really does feel a bit nasty. But if we can turn to the US, there you have a situation where the Keynesian economists, the interventionists, have been intervening progressively in the economy. They've ratcheted up the debt on every credit cycle. They're now in, a cul-de-sac where they're desperately looking to ratchet up the debt even more. It's difficult to see how that process can continue. The wonderful Austrian economist, Ludwig von Mises, predicted that this sort of thing would end in tears in time unless the policy was reversed. I don't see the policy being reversed, and indeed the Fed is trying very hard to perpetuate the expansion of credit, which rather suggests that we're still on course, if you like, for the catastrophe. Is that how you see it? And if so, how far do you think we are from that, if you like, von Mises catastrophe?
Yeah, well, it has felt to me like we were very close to a total crack-up of the U.S. system for years now, and they've been able to keep things going for a lot longer than seemed reasonable. And the reason that we in the U.S. can hold it together, despite the fact that we owe, if you add it all up in our system here, it comes to about $1 million per family of four right now. The reason we can keep it together is that we have the dollar. Everybody in the world still wants dollars, which means we can borrow hundreds of billions or trillions of dollars a year and get away with it. And that allows us to finance and to push out into the future a lot of debts that would otherwise come due or default or, in one way or another cause us to have to live within our means, which we can't do. And so as long as the dollar remains in the eyes of most of the world a safe haven, a risk-free asset, et cetera, we can get away with this. But the day is coming, just because, you can bend economic laws, but you can't break them. And eventually, the oversupply of dollars in the world will cause people to realize that it's not a good store of value after all. And we'll reach a tipping point where everybody tries to get out of dollars at once, and the value of the dollar will plunge, and then we'll lose the ability to kick the can down the road. And at that point, we will have to live within our means, which means cutting a couple of trillion or 3 or 4 trillion, depending on how you calculate it, out of our spending each year, which would basically send us into a Spain or Greece-style depression. And now that is out there somewhere, but there's no way to know whether it's the end of this year, or the end of next year, or somewhere in between, or further out. And we just know that it's there because the numbers are so compelling at this point. We just owe so much money that we clearly can't pay off, and at some point that bill has to come due. But unfortunately, from an investor standpoint, you can't know when it's going to happen. So you just have to be kind of prepared, be in the way of that process and just let it unfold without expecting to make money this month or next month, because you can't know how it's going to turn out in the short run.
That's interesting, because your analysis about the dollar, I think, is correct insofar as, yes, it is a reserve currency, so when everything goes wrong, we all rush towards the dollar for protection, and most of us account in the dollar, if I can put a hat on as an internationalist, if I can say that. But this is very, very similar, I think, to the situation back in the 60s and early 70s, when America started winding down the Vietnam War, and there was a flood of dollars trying to get back in. Interestingly, quite a lot of it through France, because presumably her relationship, she was the colonial power in Indochina going way back, so presumably quite a lot of the dollars came back via France, which led to the suspension of the convertibility of gold for central banks. Today, I'm just sort of drawing a parallel with your analysis, which I find interesting. Today, we have China, we have India, we have various other countries in Asia trying to seek a different currency to do their trade settlements in. Do you think that, if they succeed, do you think that might lead to a similar flight of dollars coming back to America?
Yes. There are similarities between this era and the 1970s, and China might end up playing the role of France, because the trade surplus countries have built up huge balances of dollar-denominated assets, and they're obviously worried about the value of those assets going forward. So they're looking for ways to reduce their dependence on dollars. And China has already cut the percentage of dollars in its foreign exchange reserves from 74% or so to maybe 55%. in the last 3 or 4 years. So they're doing it. They're transitioning out of a total reliance on dollars. And I think at some point their reliance on dollars will be small enough that it ceases to be crucial to them. And then at that point, it's possible that a lot of dollars that are now sloshing around out there in the world flow back to the United States. And in effect, that causes inflation domestically here. Causes the value of the dollar to go down. If more people are dumping the dollar and or trying to use it to buy U.S. assets, which would bid up the price of assets and bid down the price of dollars. And so that's the process that we could see out there at some point. And as you said, all these trading blocks are forming that might use their own currencies rather than the dollar for settlement of commodities like oil and grains and other foodstuffs. And that would lessen the need for dollars out there too. Yeah, so the process is underway. And it's completely logical from the point of view of our trading partners to lessen their dependence on dollars. And we're kind of enabling that by behaving badly. We're still running massive deficits. We are, while the rest of the world is grappling with some form of austerity, we basically just have the pedal to the metal here. We're spending more and more each year and trying hard to get consumers to spend more, and we're doing everything we can to antagonize holders of dollars out in the world. And at some point, they're going to feel confident enough to act by dumping a lot of their dollars, converting them into real assets, and sending the value of the dollar down. It's inevitable, but again, the timing is impossible to predict.
Yeah, that's the sort of crack-up boom, I suppose, in a sense. I'd like to come back to China and gold in a moment, but if we can just concentrate on the US at the moment, it seems to me that all government forecasts for budget deficits and so on and so forth are still predicated on the idea that the economy will recover. That is the underlying assumption. But from over here, I don't see any sign of that. And furthermore, while they keep interest rates at close to zero, the effect of that, I think, is to destroy savings. Savings which I would have thought would be required for any sustainable economic recovery. Can you set my mind at rest on that, or have I got it right?
No, zero interest rate policy devastates the savers of the world, especially the retirees who are on fixed incomes. There's a whole generation of people in the U.S. who put away some money and expected to live on the interest from that money, and they expected 6 or 7% on bank CDs and safe bond funds and things like that, and now they're getting 1%. So they're getting maybe 15 or 20% of the income they expected going forward, and this is what they were going to live on. So their lives are being devastated, and but it's not front page news. This is a very silent devastation, and it has the same impact on savers, people who might want to put some money away and try to let it grow in order to save for retirement or to put their kids through college or whatever. You can't earn anything on money that you save now. So yeah, the incentive to save is virtually nil in the U.S., and the incentive to borrow is dramatic because it's being subsidized. I mean, we just refinanced our house for 3.625% for 30 years. Now that's incredibly cheap money, and the government is explicitly encouraging us to go into debt because they've kept interest rates low for so long. And this is a obvious logical response to their situation, which is a gigantic debt implosion. They need to keep interest rates low to keep the existing debt from just blowing up and destroying the whole financial system. But getting here in the first place was disastrously wrong-headed. We made mistake after mistake after mistake over the last 30 years that has brought us to this point where now the government in the U.S. sees no choice but to keep interest rates at zero. And actually, as I'm sure you're aware, several countries are now selling bonds with negative interest rates because the financial markets are so traumatized and so terrified of what's going on out there that they're willing to basically just pay a fee in order to have a government warehouse their money for them. But the effect of that is to shrink the GDP of these countries, because if your capital is earning a negative rate of return, that means it goes down over time. And that means that your economy shrinks over time to the extent that your capital base is shrinking. And so negative interest rate bonds actually have the effect of putting these governments in an even deeper hole in the future because they cause the economy to slow down, less capital to be formed, fewer taxes to be paid, and bigger deficits out there, which require more borrowing. And that's the process that we've begun with our zero interest rate policy, and with taking on so much debt that we've allowed the system to get to the point where it's imploding. So that to get back to the original point of our talk, there is no solution for any of this. And, there's no way out. Because if we raise interest rates, the debt that has to be rolled over is rolled over at a higher rate, which starts a death spiral where government finances get more and more out of whack as they roll over more and more debt. And if we don't let interest rates rise, then we destroy a whole generation of savers and retirees, and end up shrinking the economy over time, which eventually leads to a crash. So, all roads lead to some kind of a disaster. And our choice now is basically between disasters, hyperinflation or a 1930s style crash. And because the debt is global and because it's higher than it's ever been in terms of global GDP, it could be bigger than the 1930s. It could be, a Weimar Germany followed by something bigger than the 1930s. We just don't know.
That's interesting. I must admit, my mind is sort of boggled at the idea of the opportunity to borrow money I don't need at 3.6% for 30 years. I think
Isn't that astounding?
That is absolutely astounding, isn't it?
I told her. Yeah. I was joking with our banker. I said, you need to sell this loan as soon as you make it, okay? Because it's a really bad deal for you. And he agreed. He said they would sell that thing to a packager immediately, who would turn it into mortgage-backed bonds and sell it to a pension fund.
Yeah. Well, if there's any left over,
so the pension fund ended up getting burned by this eventually.
If there's any left over, do let me know. I think that's staggering. But the serious point behind this. Surely is that as you say, it's racking up the amount of debt in a completely unproductive way, and it raises the question: what happens to all this debt, which is a bubble? It's another bubble, really, I suppose, when interest rates rise, which eventually they will have to do. And that raises the further question: do you think that the Fed can actually hold interest rates down at the zero bound until 2014, 2015, as they're currently saying?
Well, they can do anything they want to as long as the world wants dollars. And so it all comes back to that. As long as the dollar is in demand around the world, then the Fed can create unlimited new dollars, buy unlimited amounts of debt from the federal government, and basically monetize our deficits, and which is what we're largely doing now. I think it's up to 60% of the new debt that the U.S. Issues is being bought up by the Fed. And so, we can do that as long as the rest of the world will accept our dollars. And
yes,
there's no way to know when the rest of you decide that you're being conned and don't want to play the game anymore. And that's when things change. But until then, we can keep this up. And,
I suppose I suppose part of the answer is that we're being conned by our own government in exactly the same way. So it's not much of a choice.
Absolutely. Yeah, fiat currency is basically a scam, and it's a scam that can go on for a long time. But it's one that historically has always ended badly, with things being taken to such an extreme that everyone figures it out and they don't want to hold the currency anymore, and everything falls apart. That's happened over and over and over again in history. And so what we're doing in that sense is not in any way unique. It's just on a bigger scale. We've never done it globally before, where 3 or 4 major fiat currencies were all being inflated away this aggressively at the same time. And so we can't predict with any kind of certainty what the outcome is, because it's on a bigger scale. It's a kind of a fractal. It's the same process, but times 20 or times 1,000, and we just can't know the outcome. But one reasonably certain outcome is that as fiat currencies fail, humanity goes back to the original money that has proven to work for 3,000 years, which is gold. So in some way, we return to a gold standard, either by a governmental decision in which we just switch monetary systems, back the dollar and the pound and the euro and the yen with gold and limit the amount of currency that can be created to the amount of gold we have in our vaults, or the market does it for us by sending gold to $10,000 an ounce, which is the same way as, same thing as saying devalue the dollar by 80% from here. And then everybody just switches to some form of gold currency, like the original payment system with gold money or something similar, and we just have the market impose it on us. Either way, we're headed that way because a modern financial system needs a functioning money. And when paper currencies stop functioning as a store of value and a medium of exchange, then we have to use something. So we will switch to the thing that has worked in the past. And the question now is, how do we make that transition? Do we do it through a series of financial catastrophes out there that basically just level the system that was created in the past, or do we do it by everybody educating themselves and voting people into office who are willing to make the transition to sound money, and then having it happen through the political system rather than via an economic catastrophe? And right now my bet is on the catastrophe side, because we really don't seem to be figuring it out as an electorate, and we don't seem to be electing people that seem to understand any of this.
Yeah, I think that's right. I mean, I noticed that you're saying when rather than if this happens, which rather suggests that anyone who hasn't had the foresight to put a little insurance in their lives to one side might find that they're in great difficulties. How do you, the price of gold has not reflected any of these developments. Is it because people like you and me look at it one way and the Keynesians all look at it another way? Or do you think that, the price of gold has just somehow become totally disconnected from events? Or is it because it's manipulated? How do you read that?
I think part of it is that the governments of the world view gold as a competing currency, and it's in their interest to keep the price down. So there's definitely been suspicious intervention in the gold market that has served to keep the price lower than it would have been otherwise. It's still gone up quite a bit, though, so they haven't been able to stop the gradual rise over time of gold. But the other thing is that right now we're heading into a deflationary part of the ongoing cycle. We've been swinging back and forth between inflation and deflation as our perception of what's happening in the world for a lot of years now. And right now, it looks like the main danger is that we get some kind of an implosion in the Eurozone, or U.S. debts just get overwhelming. We can't figure out how to grow. And it looks like the world is dropping back into a recession, which is deflationary. And that in those kind of circumstances, it's not as compelling to buy a bunch of precious metals. So you're seeing people take profits and being less interested in loading up on gold and silver than they were a couple of years ago. Now, what will probably happen is that we will indeed have some deflationary scares going forward. The global economy will slow down some more, or something will happen in the Eurozone where Spain's debts blow up or something like that. And it'll scare people. And that's what the gold market now is predicting, because it's off so dramatically, and it's been flat lately. But the governments of the world will respond to this with a new quantitative easing program here, and something similar in Europe, and something similar in the UK, and in Japan, of course. So once we get the coordinated liquefaction of the market by the world's central banks, which will come if we drop back into recession, then that will send us back to worrying about inflation, and then gold and silver will probably soar again. So we'll have another leg of the bull market, but it will probably be driven by central bank actions, which haven't happened yet. So
yes, that's interesting.
I would say that at some point, yeah.
That's interesting, because one of the things I look at is true money supply in the States, and at the moment, I think there's roughly $32,000 or $33,000 of true money supply in existence for every ounce of gold that the US government says it owns. Now, if you look at the relationships of the value of gold held to the amount of true money supply in circulation, then we're pretty close to the lows. I think we're about 4.5% or something, without doing the arithmetic in my head, which is pretty unreliable. And historically, that's very much at the cheap end of the scale. And I just wonder how long this situation can exist. But I notice that true money supply has got a tendency to slow a little bit in its growth rate. And that supports perhaps what you've been saying, and that is that there is a deflationary environment out there. And if that is the case, then surely they're going to step up the production of cash money as opposed to credit money to counteract the potential for credit contraction. I know that this has been the policy since the banking crisis 3 or 4 years ago, but it could well start with a new vengeance, perhaps. I mean, do you think this sort of sitting on their hands and sort of quietly expanding cash money in the economy is going to change to something more aggressive? Do you see that, perhaps?
Oh, yeah, absolutely. Well, see, they've been hoping that all the currency that they pumped into the system over the past couple of years would have the effect of speeding up economic growth. And it's not really happening. The global economy is terrified of what's happening in Europe and worried about a slowdown in China and obviously worried about the U.S. And so you're not seeing as much capital formation or consumer spending as you would normally expect with interest rates this low. So it's not working the way the world's central banks hoped that it would. And if we start to tip over into negative growth globally, that's a disaster because there's so much debt out there that won't be serviceable. So much of it isn't viable now, and with the economy of the globe growing slowly, but let us drop into a global recession, and that dramatically multiplies the amount of debt that goes bad out there, and the world's central bankers can't let that happen. So they will come out with something that if $10 trillion didn't work last time, we'll do $20 trillion, because it's all make-believe to these guys. Money in the U.S. right now is just a mouse click. You type in $500 billion and you hit send, and Citigroup's reserves go up by that much. And so for these guys, it's easy to add zeros, and they will do that. They'll come out with as large a number as seems necessary to keep the global economy from dropping into a deflationary recession, which they're afraid would turn into a deflationary depression. And so, yeah, we'll see something like that in the next year. I would have expected it before the election, because usually heading into an election is when you get the really extreme economic mismanagement, at least in the U.S. And it hasn't happened this time around, which is dangerous for the party in power, obviously. But also means that we might have a different kind of post-election economy, because normally you have a boom heading into an election, and then everybody takes the hard decisions right after the election, and you have kind of a slowdown. And it might be flipped on its head this time. Maybe we'll be in such a crisis that the next administration will come in and talk to the Fed, and the Fed will come out with a gigantic quantitative easing here in the U.S. And that's when we'll see it. So, the timing of this, again, as with everything, is impossible to predict. But somewhere out there is a massive increase in liquidity, probably coordinated now with all the central banks of the world joining in at the same time. And that should impact hard asset prices. You would think that a lot of that liquidity is going to flow into things that are a protection against the downside of massive quantitative easing, which is a currency crisis. So you could see sometime in 2013 a few days where gold is up by $100 an ounce and silver gaps up by $10 an ounce, and that becoming the quote unquote normal mindset for the market, where we just expect hard assets to go up because the central banks have totally panicked. And I personally, I'm looking forward to it in terms of my own finances because we own a lot of gold and silver, but I'm terrified for what that means for the world, because when we do have that final currency crisis, it's going to be unpleasant for almost everybody under almost all circumstances. Gold at $5,000 an ounce will be fun for the gold bugs who own it, but they'll be living in a world that'll be terrifying in every other way. There'll be rich people in a disastrous world, and that's not really my preferred scenario. I'd like my kids to grow up in a relatively placid world where there are lots of jobs and where money is sound and where there aren't crazy wars everywhere. But unfortunately, I don't think that's in the cards.
Yeah, it's the sort of crisis first, solution second, rather than someone having the foresight to actually grasp the problem. And I was reflecting on this. There was a YouTube broadcast of Paul Krugman promoting his book in Spain, who, as I'm sure our listeners might be aware, is a very, very committed Keynesian. In fact, he provided the foreword to a reprint of Keynes' book on money, credit, and all the rest of it, theory of employment, money, and credit. One of the other economists at this forum, Pedro Schwartz, who we happen to know, and is an Austrian economist, took a completely different view, one of which I think you and I would sympathize with. But the problem is it's not people like Pedro Schwartz who are being listened to in government. And I don't know how a politician faced with Keynesian solutions, which have been applied in the past but failed, but all the Nobel Prizes seem to go to Keynesian economists or monetarists nowadays, and they're being told that you've got, the problem is you just haven't done enough printing, you haven't done enough government intervention in the economy. It's very, very difficult under those circumstances, I would have thought, for politicians to come up with a solution. Would you agree with that, very briefly? Or do you think I'm being a bit hopeless?
I agree. And the reason, one of the reasons that Keynesian economics is so attractive to politics and the media is that it counsels doing something. It's very hard for a politician to sit by while things are getting worse. And, the Austrian prescription for excessive debt is to let the debt be wiped out. You have a really hard couple of years, and then you wipe the slate clean, and you can begin growing from a sustainable point then, and you get yourself another 20 years or so of reasonable growth. That's the Austrian take on debt bubbles. And that's very painful for people in office to implement, because that means you've got to sit there while everybody's complaining and everybody's telling you how hard their lives are and everybody's going to vote for the person who promises to do something. And so the pressure is on you to adopt a Keynesian point of view, which is to say, all right, look, we're going to fix this for you. We're going to cut interest rates, and we're going to increase the money supply, and we're going to increase government spending. And so this allows you to be actively trying to solve your constituents' problems. And so politicians will always, if Keynes had never existed, politicians would still be choosing Keynesian solutions to economic problems.
He would be invented.
That's how you get reelected.
Exactly, he would be invented.
But under a different name, because that's just the impulse when you're in office. You can't sit still. And so it's very hard to run a country along Austrian lines. And
indeed.
So, the country that is run along those lines would tend to win in the long run, but you have to have a very far-sighted, very mature populace in order to let politicians just sit there while debt is being wiped out. And we don't have that. Certainly not in the U.S.
Well, we don't anywhere else, so far as I'm aware. So I think if I can summarize your views very briefly, we are at a point of enormous economic danger. It's very difficult to see a way out of this beyond just keeping fingers crossed and hoping. People would be well advised to have some insurance against it. Would you say that's right? Is that how you would view things?
Oh, absolutely. Yeah, because we can't fix the macro side of this, individuals. It doesn't matter who we vote for. It doesn't matter, where we live or how we manage our own lives. What's going to happen is going to happen at the macro level. But we can guard our family and ourselves against some of the worst of this by moving our finances away from paper currency. Get rid of your savings accounts that are denominated in dollars, and certainly don't own long-term bonds, and move that money into something like gold or silver or various kinds of commodity funds that cannot be created in infinite quantities by a government that's panicking and running the electronic printing press flat out. And so in that way, you end up with capital at the end of the process, and you end up with the wherewithal to protect your family. And that's really all you can do. It's not a guarantee that your life will be great afterwards, but it means you will have some options, as opposed to the person who loses their job and sees their savings wiped out in a currency crisis and ends up with nothing. And that's going to be a lot of people when the time comes.
Well, let us hope it doesn't happen. John, thank you very much indeed for taking part in this podcast, and perhaps we might have you again sometime.
Great. I'd like that, Alasdair. Thank you.
Thank you.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.
I'm going to be very, very messy and possibly catastrophic. But we'll have to see, because we've never been here before, so there's no way to predict the details and the specifics of the process as it unfolds.
Yes, I agree with that. It's always impossible to know in advance exactly what the future holds. But I think the solution that the creditor nations within the Eurozone take control of some sort, economic or political control of the other nations, to put together that solution takes quite a lot of time. I don't know about you, but I don't feel there is that much time. I think the time is probably measured in weeks rather than years. I might compromise and say a few months, but it really does feel a bit nasty. But during the 1990s, he turned columnist and author and currently writes for CFA magazine. Welcome to the podcast, John.
Thanks for having me on, Alasdair.
Idaho isn't all that far away from California. We hear very little about Idaho, but we hear that California is in an absolute financial mess. Is this true?
The U.S. in general is a financial mess, and California in particular over near us. So it's interesting now that Europe is hogging all the headlines, but the U.S. has a lot of troubles of its own, which will become front page news in due course. It's just a matter of different trouble spots moving on and off the front burner as far as the media goes.
Yeah, that's very much the feeling I get. I should think that America...
Very basic design flaws now that are now coming to light, and it's left the peripheral countries with excessive debt and no real way of paying their debt, because they can't devalue national currencies because they don't have them anymore. And it's left the core countries in Europe basically on the hook for the debt of the periphery countries. And the only two solutions left are kind of a big bang breakup where the Eurozone just fractures, which would cause probably a global depression, certainly a European depression. And the other alternative is a fiscal union along the lines of the United States, with basically Germany running the show, which for obvious reasons isn't the preferred choice of most of Europe. But that's it. Those are the only two choices. And so they're sorting it out now, and I suspect the process is going to go on for a long time.
The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alasdair Macleod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alasdair Macleod on behalf of Gold Money, and with me on the line from Idaho is John Rubino, whose website is dollarcollapse.com. John co-authored a book with our very own James Turk in 2007 called The Dollar Collapse and How to Profit from It, and it was published by Doubleday. John worked on Wall Street from the 1980s as a bond trader, an equity analyst, and finally a junk bond analyst. He was quite happy in that sense that Europe is hogging the headlines. That really is deteriorating into something which is very difficult for to see how they're going to get out of. Is it something that you follow? Do you follow Europe? I just wondered what your perspective might be.
Oh, of course. Yeah, I think the whole world right now is following Europe. It's a fascinating story, and meaningful for everyone. Europe is. I think the Eurozone is the biggest single economy in the world right now, and it's a huge export and import market for most of the other trading countries in the world. So yeah, what happens in Europe matters to everyone, and it doesn't look like there's an easy way out. And the reason for it, which you've heard plenty of times before, is that the euro common currency was set up with some